I have to thank Butterfield and all the other libraries for coordinating this. I always love when the librarians get together and work together on that. So thank you. Kudos to all of you. You've done an outstanding job. I often get a question about who is SOFA and why did you join SOFA? SOFA is a nonprofit organization started in 1993. It was really designed to increase the financial literacy one community at a time. My partner and I, Brian Cody, Brian's a CFP, also a former nuclear engineer. He has taught the CFP curriculum at Fairleigh Dickinson for over 10 years. We both said that we wanted to have a way to give back to our community. SOFA was a great way for us to do that. We do this as education only. We are not here to push product. We are not here to sell anything. I may talk about some different elements to illustrate the way that these different products may work, but I'm not going to talk about any particular company at all because I'm not here, as I said before, to promote them. As I said when we started tonight, I am operating via laptop, so please bear with me as I roll along since the laptop doesn't always seem like it wants to participate with me. So I'm going to hop right into some of our key slides, the first one being the real elements of success with regards to retirement planning, and in particular today, is due to planning. But I will say the following about planning. Every single time that we seem to get comfortable with the plans that we've made, things get changed. As we are talking tonight, the federal government's discussing some new tax legislation, which could really throw a number of things into some real disarray for people who have already done a lot of planning. I'll talk a little bit about that tonight, not a whole bunch, but there are some significant elements that I want to touch upon. As I think about preparing for retirement planning and creating sustainable incomes, there's really a couple of major items, and on the left side of this slide, you can see them. The first one is preparing for longevity. One of the key elements that we've found over the last number of years is that people really have no understanding of what that element means. I'll give you a perfect example. When I first started in the business, it was rare that I ever met somebody in their 80s. Today, if I asked every one of you on the call, do you know many people in your 80s? I'm sure you would raise your hand immediately. And if I said, how many people do you know in their 90s? You would probably look at me and say, yep, I know people in their 90s too. And today, I even know people that are 100, and I can remember that was virtually never said before. So we're seeing longevity is a key element, and it's a key element because for many, many people, they will run out of dollars before they run out of their retirement. So it's critically important to pay attention. The second element, well, we're all getting a chance to see it today, higher prices. Those inflationary pressures not only continue to apply today, but they will apply all the way through your retirement. So as I get towards the end of this presentation, you'll see some things where I talk about Dr. Wade Pfau and Dr. Moshe Milevsky, two of the premier academics in the field, and their thoughts with regards to the issues today of inflation and higher prices and in relationship to the expectations of what we have for fixed income components and what they'll provide in terms of income to us. Next, rising medical and long-term care costs. Over the last 2 to 3 decades, those two elements in particular have been far in excess of what the inflationary elements are. Next, possible changes in Social Security. We see an awful lot of potential changes to Social Security in some of these new tax bills that are coming out. And then lastly, investment risks, and I'll get into those components as well. So let's first talk about the increases in life expectancy. And as you can see, we've seen an increase of about 2 years per decade over the last 5 decades, 6 decades. That is significant. That is the fastest rise in life expectancy that we've ever seen in the history of this country. So as I always tell people, if you get to 65 years old, you really should be thinking of a minimum of 20 years of retirement. So it's very important to think about that from a realistic standpoint. I'll give you a second statistical fact. If we have a married couple age 65, and I said to you, what do you think the probability is that one of the two of you will make it to at least 90 years old? The statistical data tells us today it's slightly greater than 50%. So it's not just the thought of you. You have to be thinking about your spouse, especially when we talk about income planning. So some of the things that you need to know: de-risking is one of the most common occurrences for retirees. 75% will reduce their equity exposure after rolling over assets from a 401k into IRA. And as you can see at the bottom of this slide, these statistics are from JP Morgan Asset Management. So this is not something that is just an arbitrary piece that nobody really did a lot of research on. JP Morgan did a ton of research. They also did it in conjunction with the other institutes. So these are really some staggering pieces of information. Most people required minimum distributions, which is RMDs, are the dominant withdrawal strategy. So in most instances, people will only take out what they have to. It's usually only people who have really done an incredible amount of saving that really take out more than the required minimum distribution. And the reason for that is people want to try and make their retirement funds last as long as they possibly can. Income and spending are highly correlated. As income from Social Security and RMDs increase, so does your spending. We see that consistently happening. About 30% of the people out there have an annuity or a pension. So you can see it's less than 1/3 of the people in the country have an additional guaranteed source of income outside of Social Security. This is one of the most dangerous elements as we move forward, especially in highly inflationary environments. The median investable wealth, meaning 401k and IRA, was about $110,000 across the country. Folks, we live in the New York metropolitan area. There's not a chance that you could live off $110,000 savings today. So many of you will have substantially more than that. And the big issues really will be, how much are you able to earn on those assets, number one? And number two, will they participate in terms of outpacing inflation over time? That's going to be a big key item for people, especially as we move forward if inflation continues to be as rampant as it's been. The most common age to start Social Security is 66, but the most common retirement age today is between 65 and 70. We're seeing a large number of people deferring their desire to start Social Security early and actually waiting till age 70. And that is because they know they are going to need that higher level of fixed income. So very important to understand those things. Tonight, because we are talking about income, I thought it would be important to talk about the prudent things to do in retirement income planning. So I first start out and tell people, evaluate your current risk level and understand your downside based upon historical elements. And just one second, I've got to try and see if I can move. I've got a whole bunch of people on the side. That's much better. I couldn't see the rest of the data on the side of it. So as I said, look at your current risk level. Let's start out there and let's understand the downside based upon historical results. And the big question there is, if you have a market downturn, will it destroy your portfolio and the income that it produces? If you're not sure of that, you ought to take a look at it. And if you're not sure how that potentially works, as I tell everyone who joins me for a SOFA presentation, you are entitled to an hour's free consultation. It's one of the things that we do to support that SOFA commitment. There's no obligation for you. If you'd like to reach out to me to discuss your personal situation, please do so. My email is at the end of this presentation. Please jot it down and reach out to me by email, and I'll try and answer as many questions as I can for you. What will you do in market corrections? As I tell people in most instances, please have a game plan for if the market doesn't have any significant gyrations, meaning less than a 10% up or down move in a particular year. And what happens if you get something more substantive like 2008 or a sequence like 2000 through 2002? You should have a game plan going into this so that you're not making reactionary decisions with regards to your portfolios. Next, how much of your income is going to be guaranteed? This is a critical item today. The greater the amount of guarantee, the higher the probability that you're going to have success through retirement, and also you're going to have less stress. Does your retirement plan offer adequate income options? If not, where will you go? Most of you will find as a result of the Secure Act in the end of 2019 for 401ks, 403bs, 457s, all of these defined contribution plans are now obligated to at least once a year provide you with an estimated income of what your account balance would provide. Many of you will be shocked at how low that is. So if it shocks you, you're going to be looking at alternatives, and we'll discuss some of those a little later. What will your accepted level of risk provide as a projected income amount, and is it guaranteed? As we look further and further along, as I said, those two prominent academics in the field really try to get people to focus more and more on guaranteed income so that they don't outlive it. If this level changes, do you have other alternatives that you can plug in? And what if you don't know how to do this? What you need to do is find a competent professional, preferably someone who's a CFP or a retirement income certified planner, specifically because these particular areas are very unique in terms of how they're handled versus just general overall planning. If you did a good job of planning for your income, did you include Uncle Sam in for more than his fair share without realizing it? So many times people build up tremendous amounts of assets in pre-tax accounts. If you're going to have a sizable distribution in retirement, in many instances, you've lost all those deduction components, you might want to look at potentially converting to Roth prior to beginning taking out your required minimum distributions or even receiving your Social Security. How much of your retirement income is tax-free? And my big question here is, could this cause a significant taxable implication because of what we call provisional income? And I'll cover that a little bit later. As you can see, provisional income planning is what I call the fly in the ointment, and I will talk a little bit more about that as we go further along. So what happens after you reach age 65? And why do I say age 65? Because that is the most common, what we call anchor point for retirement planning. As you can see, after you've reached the age of 65, what's the probability of living, for example, to the age of 83? Well, it's 56%. 89 is 31%, and 14% chance for 94. But when we combine that with a spouse, all of a sudden that probability goes up to slightly over 50%. So for husband and wife, age 65, retiring today, especially in higher income areas, because we're noted to take care of ourselves better. Why? Because it's generally a higher educational level. So as a result, people live longer. So you have to plan for a much, much longer period of time today. Inflation. This is a big issue today because everyone is beginning to feel the higher prices. The key element that I want people to recognize is when they talk about the consumer price index, it really is not an accurate projection of really what's happening with inflation. Why? Because in most instances, the CPI removes two of the most volatile elements, food and energy. I don't know anyone who can live without those two components. So if you look at those two components, energy costs are up almost 40% from last year, and food pricing is up close to 30% from last year. So although the federal government would like to take those out because they're volatile items, they are the two most volatile items that basically impact the lowest income people the most. So it's very important to pay attention to inflation and understand the impacts of it. Those are the multiples with regards to inflation. If you had a 3% annual inflation rate in 20 years, we would multiply it by 1.81 to determine just exactly how much purchasing power you had lost. Same thing for a 30-year period of time, would multiply it by 2.43. So let me give you a little bit of an example of some of these things. So here's a 3% inflation factor starting in 2019, and we'll go out 20 years. At a 3% inflation factor, a bottle of milk goes from $3.50 to $6.38. And if you did that for 30 years, it becomes $8.19. You can see $150,000 median home in 2019 has increased in price by almost $200,000. Typical retirement expenses of $50K have more than doubled in 30 years, up to $117,000. But here's the big one down the bottom. From 2018 to 2021, healthcare spending was projected to grow at an average annual rate of 6.2%, far exceeding the 3% projection that I had above. And what we're seeing now is in the regular inflationary pressures have been even higher. So when we couple those two things, very important to start planning well in advance for what these costs are going to be. In terms of medical and long-term care costs, this is a very significant item, and I'm going to tell you why. There are some legislative provisions coming out, and in short order, you may get to a point where you will either be taxed so that long-term care can be provided for you from the state as time goes on. That's in one of the bills. Or the other one is you may be actually forced to purchase long-term care because you're going to need it to offset those costs. Why do I say that? I say it because the probability of someone age 65 before they pass away of having a long-term care stay is 71%. So you have to be aware of this, and you need to start to think about planning for this for the future. Please pay attention to it. Paying your share under Medicaid, Medicare Part B. By the way, let me just update you. This is an old slide. I'm about to update it. The baseline has moved from $148.50 up to $180, I believe it's $188. So all these numbers are going to go up. So for those of us who are living in the New York metropolitan area, you can see the costs for Medicare is going to continue to rise, and it's probably going to rise every bit with the price of inflation, if not more so. Why? Because we will see more and more people participating in the Social Security and Medicare rolls as we move forward, especially as more and more of the baby boomers start to get onto those Social Security rolls and Medicare rolls. So what are some of the possible changes in Social Security, which is what we call OASDI, which is Old Age Survivors and Disability Insurance? Well, there's quite a number of different changes that may be coming as we move into the future. Some of the key elements is pushing out the age that you actually can get your full retirement benefits. Currently, it's between 66 and 67, depending upon when you were born. If you were born in 1960 or after, your full retirement age is 67. There's a discussion now that those born 2000 and after, they may push that full retirement age from 67 out to age 70. We may also see Social Security become what we call needs-based. So there's really significant changes that are potentially coming as we go further and further down the road. I always like to bring this slide up for a very specific reason. Well, let me see, it didn't take it for some reason. There we go. All right. These are the income tax rates historically in the United States. Many times I hear people today saying, my God, these income tax rates have just gotten ridiculous. And I say, if you think they're ridiculous now, go take a look at what they were in the past. So you can see back in the 1930s all the way through to basically the mid 1960s, the top brackets were up to as high as 90%. I think we will continue to see these tax rates rise. Why? We're $28 trillion in debt. Somewhere along the way, either we're going to start to have to pay this down, or the only thing I can tell you is your children and grandchildren are going to pay a lot more in taxes as we go further and further along. That's not something that I'm very, very happy about. I don't want to see that happen. I think that that will be devastating because it will lower the overall standard of living for people if they have to pay that much more in taxes on an ongoing basis. So let's get into some of the investment risks and interest rate risks that people have to start to pay attention to. And there's a reason why I want to do that. As I was talking to some of the librarians before we got started tonight, I was talking about an example of what we call target date funds. And target date funds are usually the default investment that you'll find in your 401k and 403bs today. Why do I talk about target date funds? Because for those people who don't know how to allocate their portfolios or don't want to be involved in it, they will have their contributions default to the default option, which is the target date. In 2008, the closest target date fund, and they operate roughly every 5-year increments, was 2010. In 2008, that target date fund of 210 had an allocation of 55% to equities or stocks and 45% to fixed income or bonds. Today, the closest target date fund that we would have is 2025. That allocation today is 63% equity, 37% fixed income. So you've seen an 8% increase in the allocation to equities. What does that mean? You're going to have more volatility and you have more risk in that portfolio. Why has the allocation changed so dramatically? Because the interest rates on bond funds today are so low that they don't, in many instances, even outpace inflation. And in a rising inflationary environment, the way that bond funds work is the interest rates, when they go up, force the principal values to go down. It's a lot like a seesaw, and I'll go through that a little bit more. As we go further along, I'll show you a nice little graph so it'll illustrate that quite clearly. If you have questions, please pop them into the chat. I've asked the librarians to please keep track of that, and we'll try and get those answered as we go along. And if you have something and it didn't get asked, please write it down and I'll be happy to try and answer them as we finish up. So one of the things that I always try to talk to people about when we talk about the stock market and these investment risks is inflation erodes your purchasing power over time, and downside years have dramatic impacts on your principal. This is why it's so very important for you to have a game plan going in, understanding that there is volatility in these markets. But what's the level of volatility that's acceptable to you and what is not? And if certain levels of volatility are not acceptable to you, yet you need those types of rates of return, what will you do? How will you go about getting those rates of return? I'm going to talk about one of the instruments that allows you to participate in both sides of that equation as we get a little further along in tonight's presentation. So let's talk a little bit about bonds and interest rates, because this is going to be a critically important component. The Federal Reserve has come out over the last few days and indicated that 2022, they anticipate they'll see 3 interest rate moves to the upside. As I said, when interest rates move up, bond prices move down. So as you can see, interest rates have an inverse effect on income. When the bond prices are high, income from the interest rates will go down. When bond prices are low, your interest rates go down, will go up. So it's kind of like a seesaw. If this is the principal side over here and this is the interest rate side over here, if interest rates go up, the seesaw on the principal side goes down. Conversely, if interest rates go down, the principal side goes up. The unfortunate side is that fulcrum point's very close to the interest rate side. So there's a lot more leverage, both up and down to principal, relative to small moves in interest rates. So it's very important to understand those, and it's very important to understand the quality of the bonds and elements that you have in those portfolios. So what are some of the strategies for creating this sustainable retirement income? Well, I like to start out by first identifying the sources of income that are available to you, and I divide them into 2 categories. The first is what's guaranteed, and the second is which of those are variable. The next element is what's the interest rate or withdrawal rate that you're going to use to dispense funds out of your portfolios. And choosing that withdrawal rate will determine in many instances how long that portfolio can potentially last for you. Next, how much management will you employ with regards to your retirement income? Or are you going to leave it to someone else to do that for you? In many instances, people start out, they'd like to do it themselves, but they find out that it's a very complex area that in many instances is not one that they're very comfortable dealing with. So if you're not, what I would say to you is please find a good, competent professional that you can work with that will help you to understand how these different elements work and how they can be integrated into your portfolio and determine, is it something you want to manage or should you hand that off to someone else? Next, global portfolio risk management. Boy, that's a big word. All I'm talking about here is what types of pieces will you put into your portfolio to create what we call negative correlation between the different investment vehicles that you use. Why is that important? Because if you, for example, had all of your dollars sitting in equities and the stock market goes down, there's nothing to offset that downside movement. Same thing if you had all your money in bonds. The bond market moves south, you don't have anything to offset it. So most people will see a combination in any fundamental portfolio of stocks and bonds. But there are other elements that can be plugged in. There are other things that can be used to mitigate some of those risks that are inherent in both the bond and the stock market. Things like commodities, things like options, and other synthetic type instruments that can be used to mitigate some of this volatility and risk in the portfolio. But you need to understand what they are and how they work. Because typically, if I say to people, we're going to put some commodities into the portfolio, they go, my God, commodities are very, very risky. I don't want to put that in my portfolio. But if I show people, hey, when the stock market went down in 2008, commodities were all up. You should probably have some of those in there to hedge some of that risk out of your portfolio. Next is addressing the specific risks that are unique to your situation. Sometimes we have people who will have employee stock purchase plans or employee stock option plans, or they will even have purchased stock from the company in their retirement plans. You need to understand the specific risks that are attached to any one of those components to determine, is this something that you're comfortable with? And lastly here, a Roth IRA as a tax strategy. Well, I would imagine some of you are probably scratching your head here. What do I mean by that? Roth IRA as a tax strategy for many people today, they will sit down, do an analysis of their situation, and all of a sudden they will recognize they don't have any write-offs when they get to retirement. They are, in many instances, pushing off taking their Social Security till they reach age 70 so that they can get some enhanced credits. So if you do that and you wait to take your required minimum distributions till age 72, which is the new requirement, what you may find is that those two sources of income, when you combine them and run them through what's called, I'm drawing a blank on it and I'll cover it a little bit later. When we get to that, when you look at your Social Security, you're going to have to go through a calculation called provisional income. Just hit me again. Roth IRAs are not added into provisional income, but if you have tax-free bonds in your portfolio, that's added into that provisional income. So many people are beginning to do what? They're converting pre-tax assets into Roth, and it's become a very effective strategy to essentially create a rudder to move things around. I see somebody's popped in a question that says, my understanding is that contribution to a Roth IRA is unavailable to individuals making over a certain amount of money. Is this true? That is correct. And if so, can I still convert my IRA funds to a Roth even if my income is above that threshold? Yes, you can. The initial legislation that's being bantied about in Congress today was going to eliminate that. If it gets passed, one of the provisions that's in this current legislation is you would not be able to make any non-deductible contributions to a traditional IRA and then convert them to Roth. They know what you're doing. You're basically trying to take the inability to make a Roth contribution and do it by putting it in as post-tax contributions in traditional IRA and then turning around quickly and converting it to Roth. They're trying to eliminate that, and I suspect that that will be eliminated. But in relationship to your question, no, you can go and actually convert any pre-tax retirement assets, whether they be IRA, 401k, 403b today. You can convert them to Roth, pay the taxes today. That will eliminate that required minimum distribution in the future. And the big advantage there, even though it has to be distributed within that 10-year parameter as a result of the Secure Act in 2019, it's completely tax-free to your heirs on a federal basis. So big advantage from there. Okay, let's see where we are here. As I said, I'm working from my laptop because I'm away at a conference, and unfortunately, it doesn't just snap on through. So I wanted to point something out before we go a little bit further. This is the national average of what people receive from Social Security. And you can see that New Jersey, Connecticut, and New York are all in the top 10 in terms of Social Security averages. But folks, I'd like to ask you a really simple question. Is there anybody out there that could live off of those numbers annually? $18,000? Not if you're living in the New York metropolitan area. So Social Security is becoming less and less of a factor in terms of the overall amount of retirement income that you're going to need to generate. As I said initially, identifying the sources of income. So for most people in early retirement, they'd like to work in many instances part or full time. I have to be perfectly candid with you. If I have somebody comes in and they tell me that they're going to work full or part time, the probability of that happening after 6 to 12 months, in most instances, people say, I've really had enough working, and they don't continue to work. Although I have to admit, my niche market for many years was working with upper level college executives and very successful small business owners. Typically, people who are workaholics continue to be workaholics throughout the rest of their lives. So I have many clients that do that. But people who are transitioning from their working lives to retirement and are doing so prior to age 65 because of either a reduction in force or a disability or a health issue, typically are not going to work part or full time, and you need to factor that in. Pension income, I should put a little red X through this because for most people, they don't have it. So the real main source for most people in retirement is Social Security. It's their most prominent element, unless they live in the New York metro area or some of the wealthier areas in the US. Later, as we get into retirement, where does most of the people's income come from? Usually it will be either from IRA withdrawals, which is typically as a result of a conversion of 401k and 403b accounts, real estate assets that they own. In many instances, for people who are in that transitional phase today, especially in the New York metro area, I've said you might want to consider liquidating that largest asset today because of the fact that you're getting, in many instances, a real substantive increase in the value of your home relative to what it was just 2, 3, or 4 years ago. Why is that? Well, there's two specific reasons. One, the SALT taxes, state and local taxes, were no longer deductible. So for those who are living in the New York metro area, we've lost that deduction. It's made homes far less appealing here. That's number one. And number two, in many instances prior to the pandemic, it was taking people in our New York metro area 2, 3, and 4 years to sell homes. So trying to liquefy their largest asset in many instances was very, very difficult as a result of the real estate environment that we're in. Things have changed, though, over the last year and a half or so. But I promise you, if there's one thing I can guarantee, things will change. I don't know how long this will continue. So for those of you that are approaching this transitional phase, you may want to look at the costs of living in much lower cost areas throughout the United States. So when I said, let's talk about choosing a withdrawal rate, you want to start to understand what's your probability of retirement success based upon the withdrawal rate that you want to take. In the old days, we used to say that if you chose to take 4% out of your portfolio, you would never blow it up. Well, there's a lot of work that's been done by Dr. Pfau and Dr. Malevsky that said if you wanted to make sure that you didn't blow up your portfolio today, the safe withdrawal rate isn't 4%. It's not 3%. It's about 2.75%. So as you can see, the more that you demand out of your portfolio as a percentage annually, the greater the probability that you put your retirement in jeopardy. So that's why I tell people today, please start your planning, look at your retirement planning, preferably 15 years before you're ready to go, with an understanding of what the interest rate environment is today, without an expectation that it changes dramatically. I could give you probably an hour or 2 hours worth of discussion on why I don't think that those things will change. And it really has a lot to do with the global environment. But the key element to take from this that I think is the most important piece, going from a 4% to a 7% expectation in terms of your rate of withdrawal increases the probability of you not having success, or decreases your probability of success by almost 40%. That's a very significant number. So you really want to look at these things relative to what your needs are. So if you have to get out there and need, for example, 7, 8, or 9% out of your portfolio, what's the probability of success? It's not very high. So it really says to people, please begin your planning well in advance and plan on putting a lot more away than you initially had expected. When we talk about planning for this income in retirement, I typically tell people, let's divide your assets into what I call 3 different buckets: short-term, intermediate or midterm, and long-term. The short-term bucket's designed to meet the immediate cash flow needs that you have, and that's where your emergency fund should be positioned. Typically, it's in cash-type instruments, CDs, money markets, short-term bonds, intermediate annuities, Social Security, pension and wages. I don't consider those short-term income buckets because you're using those wages and those Social Security pension income components, and they are coming in and you are using them right away. So they're really not a bucket that you get a chance to hang on to. Immediate annuities the same way. So those last 3 pieces, you're spending typically the entire amount in the initial stages of your retirement. The midterm bucket, what I'd like you to do is hopefully be able to take a little longer term approach to it. Here, we'd like to employ some growth and some income, but if we need to, we'll replenish our short-term assets with dollars that are positioned typically in this category. Here, we'd be looking at either individual bonds or bond funds, deferred annuities, either of a fixed rate nature, an indexed rate nature, or a variable annuity. Absolute return funds, we're seeing a lot more of those types of strategies and managed distribution strategies, asset allocation funds and balance funds. And in this midterm income bucket, for all of those of you who pay attention to government types of securities, if you're interested, you should be looking at I bonds. You can only put away $10,000 in a year, but the current rate on I bonds is 7.12%. As long as you keep it there for a year, you don't lose any of those earnings. And if you keep it for the full 5 years, you won't have any penalties when you take it out. If you take it out between the end of year 1 and the end of year 5, you would give up the last 3 months of interest. But with inflation as high as it is, these Series I bonds have become a very talked about element in that the environment today for income. So one of the things that I've been talking to parents and grandparents about saving for their kids today, and saying, gee, I'd like to get something that gives me more than what I can get in a savings bond or so forth. Please look at those I bonds. Again, as I said, you can put away $10,000 annually. So if you wanted to fund it this year, you could put $10,000 all the way up until the end of the year, and the beginning of next year, you put another $10,000 in for them. It's a great savings vehicle for grandchildren. And then long term, these are the pieces that you hopefully will be your inflation hedge. Typically, it's your growth stocks and growth funds, real estate, commodities, and today, dare I say, cyber currencies. There's an awful lot of discussion about those things. We continue to expand our knowledge in those areas, but today there's about 150 different cyber currencies. There's a great deal of discussion at the upper ends that they really aren't currencies today. They truly are much more commodities because of the fact that they're not truly mediums of exchange, just like cash type items are, but they're getting closer and closer to that. So they could be very good options as hedges in your portfolio against inflation. So as you can see, when we talk about retirement income planning, there's an awful lot of different areas that you can go to climb into and position assets for the future, but you really need to spend some time understanding what they are. What is the elephant in the room? And I put this slide together because for the last 30 years, we've been in an environment where interest rates have continued to come down. And if you remember, as I said before, as interest rates come down, principal values go up. Well, we have reached a point where those interest rates really can't get any lower. And now they may start going back in the opposite direction. So although you would get a higher interest rate from your bond fund, your principal will suffer significantly. Let me give you an example. If you have an investment grade bond fund, and let's say that it was an average AA credit quality, and you were holding on to that bond fund, and that bond fund had a duration of 10 years, what duration tells us is how sensitive is that bond fund to an interest rate move. Well, if interest rates move up 1%, a bond portfolio with a 10-year duration would see a 10% decrease in its principal value. So yeah, you got 1% more in interest, but you lost 10% in principal. So very important to understand those things in relationship to the environment that we're in today. And as I said before, the anticipation that the Federal Reserve Bank will have 3 interest rate moves to the upside, as well as they're stopping the bond purchases in the bond market. They expect that that will reduce the liquidity in the bond market by about 1.5 trillion next year. So when we combine those two elements, you could potentially see a fairly sizable rise in interest rates, and especially if the Fed has to use interest rates to combat inflation and slow the economy down. So please be aware of that. Please recognize it. Ask your advisors if you're working with them, or do some reading about the implications of a rising interest rate environment and what it will do to your bond portfolio. Next, what happens to a portfolio if it starts out with negative returns in the early years? I'm going to talk about that when I get into some of the key elements in a couple of additional slides further down the road. Couple all these pieces together, and the next logical question is, what other income options can help me lower my risks and improve my probabilities of not running out of money? These are key questions, folks. These are the 2 key areas: increased longevity and higher probabilities of running out of money, that have had Dr. Wade Pfau and Dr. Moshe Milevsky doing so much research, working so much with the investment community to educate people about the implications of these things in the future. Very important to pay attention to them. As I said before, I wanted to talk a little bit about interest rates and how they affect bond prices. As you can see from this illustration, see where the fulcrum point is on this seesaw? It's really close to the interest rate side. The bond or principal value, which is the top right, is much further away from that fulcrum point. So if your yields rise, your bond prices are going to drop. And if yields drop, your bond prices will rise. Well, this illustration right now shows where yields are today. And if interest rates rise, you can see what's going to happen to bond prices. So let's look at this illustration on the left, on the little graph. So we have prices in the left column, yield in the center, and interest on the right. I'm going to use that middle line, that $1,000 price, 10% yield, and $100 as the original bond, meaning that's what it was issued at. So when that bond was issued, if the interest rate environment didn't change, you would have continued to get your 10% or your $100 worth of interest, and your bond would have stayed pretty close to $1,000. Over the last 30 years, if we watch that 10% yield drop, which we did watch interest rates drop, we can't change the amount of interest that the bond pays, but we have to now make that interest of $100 equal to what the yield is in the environment today. So if it dropped to 5%, what would the bond be worth? Well, it'd be worth $2,000 because $100 worth of interest equals a 5% return. So your bond would have gone from $1,000 in price to $2,000, although your yields had dropped. Conversely, let's look the other way. If interest rates went from 10 to 20%, I have to make that $100 equal to a 20% return. What's happened to the bond price? It got cut in half. So you can see big impact to pricing when yields change. So please remember that as you start to evaluate your portfolios and where they stand. This is the slide that I always hate to get to, but it's the big one in this presentation. And it's called the retirement killer. Why sequence of returns matter? Well, the sequence of returns is going to have a lot less of an impact on a portfolio of a long-term investor who's no longer putting money in, but they're not taking any money out. So it really doesn't have a big impact on those people. However, the relationship between an investor's rate of withdrawal and the sequence of returns can have a dramatic impact on a portfolio's ability to last during the withdrawal period when you're taking income, or usually during retirement. So I'm going to go through two illustrations, and you're going to see some very significant differences between these two. And when I'm done with them, you're going to have a much clearer understanding of just exactly what sequence of returns is and why it's such a critical factor in retirement planning. So let's first start out talking about the factors that affect the portfolio results before you retire, or what we call the accumulation phase. So in the top left, average annualized returns, your asset allocation, and staying invested are the three critical elements during the accumulation phase. So in this example, we're not taking any income yet. We had starting values for portfolio A and portfolio B of $100,000. Both of them averaged 8%. So when they reached age 65, they had the same amount in the portfolios. No difference. No big deal, right? Didn't matter what the sequence of return was. However, when we get to retirement, you're going to see that things change, and they change big time. When we get to what's called the distribution phase, now the three critical factors are sequence of returns first, product allocation, and portfolio protection. In this instance, we're going to assume that you're taking a 5% rate of withdrawal, and we're going to adjust it for inflation every year thereafter. So we're starting with the same portfolios of $684,000, and we're getting the same average rates of return. But look at the difference between portfolio A and portfolio B. Why? Look at the first 3 years of performance under portfolio A in that left-hand column, -12, -21, -14. Those 3 years of poor returns, look what they did to the portfolio balance. That portfolio wasn't ever able to catch back up and ran out of money at age 82. Conversely, in portfolio B, the first 3 years were very good. Look at the difference in the ending balance. So as you can see, sequence of returns is critical to retirement planning. And the earlier you go, the greater the risk. So for example, there's another term, what we call the high risk corridor. So those first 10 years from when you begin your retirement, you convert from working to begin retirement. The earlier you do that, the longer that high risk corridor lasts. For people starting at age 65, it's approximately 10 years based upon life expectancies today. If you go back and start at age 60, it now has a 12 or 13-year high risk corridor. And if you leave in your early or mid 50s, it can be as long as 15 to 17 or 18 years as a high risk corridor. What does that mean? If you have an adverse sequence of returns, you have the potential of destroying your retirement and running out of money. So critically important to understand those things. I always want to tell people that ahead of time. So that brings me back to the lifetime income sources, and which ones do you have? For virtually all of you out there, you'll have Social Security. It'll be the rare individuals out there that have a defined benefit, or what we call a pension plan. Many of you will have defined contribution plans, or 401ks, 403bs, 457s. And that last element, annuities, has become a much more critical element over the last number of years. And Dr. Fowle and Dr. Molesky have gone through why this is such a critical element as we go further and further along. So I'm going to have a quick discussion about that with you. What is an annuity and what can it provide? Well, for most annuities, it can provide lifetime income options today, especially through the different riders that are available. And I'll cover some of the basic ones, but I won't get in great depth. As I said, today we're going to kind of look at these things from about 5,000 feet. And you also have a death benefit to protect your beneficiaries. And in many instances, you can add death benefit riders to these components so that you can not only protect the death benefits, but you can also protect the lifetime income components as well. There's many different types of annuities today. There's single premium annuities. There's flexible premium annuities, meaning you can have a one-time lump sum contribution, or you can do it on an ongoing basis. You can find them with fixed rates that are guaranteed. You can also have variable ones that your performance will be determined by the underlying mutual fund, or what we call separate accounts that are being used to manage them. Or today, you may even see indexed annuities where you're basically participating to a certain percentage in an index of your choice, whether it may be S&P 500, NASDAQ, or there's quite a number of other ones, but you have no downside risk. So if the market had a down year, you would get zero as a performance. You just wouldn't have a loss, but they will cap your upside performance. And then lastly, there's deferred versus immediate. If you'd like to wait to take income, you'd purchase a deferred annuity. But if you'd like to begin income payments immediately, you would use an immediate annuity to do that. And in some instances, people will use the riders rather than purchasing an immediate annuity and starting that annuitization. If you have an interest in this area, you need to meet with someone that understands the differences between all these different products and how they work. In many instances, we will couple these things together to provide different risk mitigation techniques and also give you opportunities to get reasonably good rates of return over time, but without having to take unnecessary risk. You also have deferred fixed annuities, which will give you guaranteed minimum interest rates. The unfortunate side about most of those components today is that those rates are pretty lousy. The deferred variable annuities, however, offer you professional money managers, just like buying an open-ended mutual fund. You typically have multiple investment options, also from multiple different companies out there. And these are really long-term investment focused. And then on the immediate annuities, you can do it either as a lump sum investment, which most people do, and you can also maximize and protect that lifetime income for a given period of time. So for example, some immediate annuities will have, for example, a payout based upon one life. Once that person passes away, then there's no residual value. They may have it based upon a joint life, where it now would pass over to that joint or surviving individual. You could also have an individual with a period certain. So for example, I'd like to have an annuity pay me for the rest of my life, but I'd like to take a 10-year period certain. What does that mean? If I was to die within 5 years, my beneficiaries would receive the remaining 5 years of that period certain payment. After that, it would cease. Many of those period certain options can be 5, 10, 15, or even 20 years long. So lots of different options in this space, a lot of different options to pick and choose from. There's many different companies out there. We've worked with many of them. There's some that we really like. There's some we wouldn't touch with a 10-foot pole, quite frankly, but that's just the way that it works. So why variable annuities? Well, if you're using it in a non-qualified basis, you have the potential for what we call exclusionary ratios. What does that mean? Well, let's say you put $100,000 into the annuity. It's now grown in value to $200,000. So you have $100,000 of principal, you have $100,000 of gain. When you start to pay that out, it's not all gain. Some of it's a return of principal. So we would have an exclusionary ratio. In this example, just for simplicity purposes, if we decided to take it out, it might have an exclusionary ratio of 50%, meaning 50% was a return of your principal and 50% was growth. So you pay a far lower tax rate because it wasn't all growth. It was a portion of returned principal. You also have the opportunity for lifetime income payout options, what we call guaranteed minimum income benefit riders, or they have a whole bunch of other acronyms that could be used to describe that, but they all fall within that parameter of lifetime income payout options. Why has that become so popular? Because it allows people to maintain a fundamental allocation in the markets to get the types of returns that they should get, but also pay for an income benefit that guarantees that that's a minimum level that they're going to be able to get in case you have volatility with regards to those income payouts. So that's a way that people can protect against that. They also provide guaranteed death benefits. And as I said, optional living benefit riders, well, I got a typo there, I got to fix that one. But those optional living benefit riders allow you, as I said before, to maintain the allocations that you want to have and stay invested in the marketplace, and yet be able to guarantee a minimum amount of income that's coming out to you. So very important to pay attention to that. Some questions to think about. Why are top retirement planning experts, Dr. Wade Pfau and Dr. Moshe Milevsky, so much in favor of having a portion of your retirement assets in annuities? Why? Because you need to try to keep pace with inflation over time. And at the same time, most people cannot live off of the fixed income elements in an investment grade portfolio today at 3% or less. So many of these annuities with their guaranteed benefit riders will have payouts in the 4, 4.5, 5, 5.5, 6, 6.5, 7% ranges. So it's worth finding out how these products work and see whether or not they fit for you, because it may allow you to maintain more of an allocation that you should and still be able to get the income that you need. What is the number one risk factor that most people do not understand? Folks, it's longevity. It is longevity. Everybody, when you ask them questions, do they think that they will live the average life expectancy or more, typically will say, you know, I might live to the life expectancy, but probably not. Well, let me tell you something. As we go further and further along with medical advancements being what they are, we're seeing people living much longer than they expected. So typically they haven't planned for the longevity risk, and they have a very high potential of running out of money. What impact will rising healthcare costs do to your retirement? Did you plan for them? Please think about the impact of long-term care. And when I do my estate planning presentation, I ask this question from the following standpoint. How many of you have talked about what happens if you have a long-term care stay? Doesn't matter if it's in a nursing home. What if it's at home? Who is going to take care of that person? Will it be the other spouse? Are they capable of doing it? Do you have the financial wherewithal to do that? What will happen to them if something happens to them and they have a long-term care stay? So you need to think about it, especially with the probability being so high for people age 65 and above. As I said, age 65 and above, you have a probability of 70% that you're going to have a long-term care type of a stay within the remainder of your life expectancy. So very important to pay attention to that. How will you protect against the downside volatility that can destroy your income sources in a down market? Do you have a game plan? The worst thing is to not understand that the market's going to have volatility. And then when it hits you, you go, oh my God, what am I going to do? We've got to liquidate. It's down. Please, please develop a game plan with your head long before you get into the volatility of the market. So this way you'll make those decisions with this and not this. Are you comfortable with management of risk to protect your portfolio? Is it something that you do? Do you understand the mathematics behind it? If you don't, get with someone who does. It will really help you. And then lastly, have you analyzed the impact of not getting your money back? Here's a hint. And Dr. Moshe Milevsky has some really great stuff for it. When I do advanced planning elements with people, I tell them, you won't be getting your purchasing power back, even if you get your money back. We saw the impacts of inflation. Rarely do we ever see people outpace inflation over time and still have an ability to provide enough income through retirement. So it's critically important to understand those things, because if you don't understand those things, you're going to get smacked in the face with it. But don't forget, one of the most important things to think about as you begin your retirement income planning is those red two words, provisional income. I'm going to go through that for you. What is it? Well, your Social Security is taxed based upon your other income. So we determine that by going through what we call the provisional income calculation, which is 50% of your Social Security benefit, any ordinary income that you earn, dividends and capital gains, and non-taxable interest. So those tax-free bonds, yeah, they're tax-free, but they may cause more of your Social Security to be taxed. So you need to be paying attention to that. And if possible, run some analysis on the implications of overfunding pre-tax elements versus potentially paying some taxes now and converting those things to Roth. If you're not sure how to do that, if you'd like to have a consultation, as I said earlier on, just reach out to me via email. We do this all the time for people so that they can get a clearer understanding of what it looks like for them, especially if they're going to be in a situation like this. So very important to pay attention to that. So how do you determine if Social Security is going to be taxed? Well, here's the best way to think of it. It's called layers. First, add up all of your gross income, then add in any tax-free interest that you receive, and then half of your Social Security. That's your final provisional income, and that's going to determine how much your Social Security is taxable. So here's the brackets currently for individuals on the top, and then jointly on the bottom. So let's walk through the calculation so you can see. And here's two different tax examples. In this first one, it's $20,000 of Social Security with $40,000 of IRA income. So that's $50,000 of provisional income. So we take the 50,000, we subtract the 32,000, and we'll just go back here real quick so you can kind of reference to it. I'm going to use the joint as our example. So the first break point, so to speak, before you'll start to determine how much your Social Security is taxable is 32K. So 50 minus 32,000 equals 18,000. So you have $18,000 that says 50% of that will be put into the calculation for provisional income. And because of the fact that you were over the top of the second threshold, which was 44,000, you had an additional 6,000 there, you're going to pay an additional 0.35% of that, or have an additional 0.35 of that, which now becomes a potential taxable benefit. So in this instance, you have 55% of your Social Security benefits that are potentially taxable. Conversely, if we had 40,000 of Social Security with $20,000 of an IRA withdrawal, we would have $40,000 of provisional income. Now, 40,000 minus that first threshold gives you 8,000. Well, we're only looking at 50% of that being taxable, and you have zero over the second threshold. So you'd only have $4,000 that was potentially taxable of your Social Security. Let's walk through the calculation. So same calculation, total Social Security as taxable, or excuse me, in the column on the left, the 40,000 of IRA plus 20,000 of Social Security means you'll have $11,100 of it that's of your Social Security that is taxable. You had 40,000 of other income, so you have total taxable income of 51,100. We're going to subtract out your standard deduction and personalized exemptions. So you'd have a net income of 23,300, and you pay 2,300, almost $2,400 in taxes. The one on the right, slightly different scenario. We only had 20,000 coming out of the IRA, 40,000 coming from Social Security. Folks, this is one of the reasons that people are deferring their Social Security out until age 70. They want more Social Security income and less IRA income. So people in many instances are spending down their IRAs and then getting more guaranteed income from Social Security. What's the advantage of it? Well, as you can see, you have far less Social Security that is taxable. When we add back in the taxable item, you had 24,000 of total income. You had 27,800 of exemptions, so you didn't have any net taxable income. So as you can see, it's a big difference depending upon how that income comes to you. Now, folks, here's the lovely part that I have to explain to you. For those of you that live in the New York metropolitan area, provisional income for you is probably going to well exceed the top threshold. So that means that for most of you, 85% of your Social Security is going to be taxable because you're going to be over the thresholds. It's just the way that it is if you live in this particular area. So lastly, if you need help, I tell people, please find somebody to help you. Find a specialist, find somebody who works in this area that can walk you through these different pieces so you can get a clearer understanding of how these pieces all fit. Develop some congruity between those types of elements that you have in there. And it is essential to prepare for certain and uncertain risks. The certain ones are easy to plan for. The uncertain ones are very difficult. And many of these retirement strategies will continue to evolve. We see it happening on an ongoing basis. Literally every month or two, we're seeing some sort of new technique or combination technique out there. So it's critically important for you to pay attention. And lastly, my favorite quote of the day from Ben Franklin: investment in knowledge always pays the best interest. It certainly does. Normally at this time, as we close in at the end of my presentation, I would ask you to please hand back in your evaluation sheets, but we're not doing these live anymore. And I have not had people going through the tediousness of this stuff online. So I want to say thank you so much for your time. I will certainly open it up to any questions at this point. So feel free to unmute yourself and ask any questions if you'd like to do so.
Okay, quickly. This is Luann Morse from the Butterfield Library, and I would like everyone to know that the third in the series that Mark Lang is presenting is titled Asset Allocation and Modern Portfolio Theory. That is now scheduled for Monday, January 24th at 7:30. And the presenting library is the Putnam Valley Library for that session. And it looks like there's someone in chat. Got to thank you.
As always, I say thank you for taking the time out of your busy schedules to listen to me bloviate for an hour. As I often like to say, I try to feed you as much information as I can so it comes out of a fire hose. You know, if you're lucky, you'll digest 10 to 15, maybe even 20% of it. But if you have questions, my email's at the bottom. It's mark.lang@lpl.com. Please feel free to reach out to me. More than happy to answer those questions for you. More than happy to work you through some of the scenarios. We've got some good software from horse's mouth with regards to Social Security strategies and payouts. Same thing with regards to the Medicare elements and things. So very important for people to really start to digest retirement planning, as I said before, preferably 15 years out from when you're going to retire, because then you can really make some substantive changes. And for those of you that are in that 5 to 10 year window out, please look at how much you put into pre-tax retirement assets and determine, especially while you have deductibility components today, if you have a potential to do conversions to Roth and pay lower taxes now and not have required minimum distributions in the future, you can use those Roths in many instances as tax rudders. For example, when children decide that they're going to get married and you go, I'm going to need another 30,000 or 40,000 out of my retirement account to pay for this. Okay. Did you want to take that out of pre-tax? Well, I have to. Oh, well, by doing that, you just bumped yourself up another tax bracket. If you had it in Roth, you could have used that as a tax rudder, taken it out of your Roth and not had to pay higher taxes on all the dollars. So very important to pay attention to these things. That's why I say, please, preferably 15 years, but at least 10 years out, start to run your analysis and see where you stand.
So are you saying to put things into Roth instead of putting it into your 401k, or are you moving
You
it?
need to run, you need to look at the tax picture, not just today, but when you're going to retire and when you expect to take Social Security, when you expect to plug in the required minimum distributions, if you have deferred compensation, if you have a restricted stock, all these elements need to be plugged in to determine, as I tell everybody, it's all about the taxes because you have a partner in your retirement plan. It's called the federal government. They gave you a break to put it in pre-tax. They want to be paid now. And I'm sorry, I love my country, but I don't want to give them any more money than I think they should get. I'd rather keep it in my own pocket. So unless you want to give them more and feel very benevolent and philanthropic, go right ahead. But that's not my idea. I would much prefer to keep it in my own pocket, spend it on my own family, and do the things that I want to do.
Okay, so this series was brought to you by Mark Lang, and he is with the Society for Financial Awareness, SOFA, that's the acronym. And again, thank you, Mark. And
Thank you so
also,
much.
the series also was brought to you by the Putnam County, New York Libraries in combination with the Field Library in Peekskill, New York. And again, the third in the series, Monday, January 24th at 7:30, and the host will be the Putnam Valley Library.
Thank you all for joining me tonight. Thanks so much. Good
Thank you.
health. Happy holidays to all of you.
Same to
Thank you, Mark.
Thank you much.
Yeah.